Good afternoon, everyone. In today's video, I'm going to walk through our morning Volatility Box note sent to all of our Futures Volatility Box members. This is usually sent right around 7:25 a.m. Pacific, and it contains a scorecard of the 10 futures markets we look at, along with which Volatility Box model we're currently using for each of those markets, and I'll add in some commentary here if we have any patterns or clues emerge. Now, today we had the S&P and the Dow on their Scalper Volatility Box model. And meanwhile, the peer in the Nasdaq futures market, along with the Russell, was on its aggressive volatility box model. Now we'll go through what this really means, how we came to it, but before we do that, let's just do a quick review. So with the indices here, we have 5 different volatility box models. In order from most aggressive to least aggressive, we have the Scalper, then the Aggressive, then the Doomsday Aggressive, then the Conservative, and then the Doomsday Conservative. The idea behind 5 models is really to be able to adapt to volatility as the day progresses, which you'll see really took place today in the S&P, where we had to transition from the Scalper to the Aggressive as the day progressed. Now, starting off here first with the morning test, let's start with the S&P 500 futures, and that's in the top left here. We had in the morning, by 7 a.m. Pacific, we had price action fall inside of our volatility box cyan entry line, and we had price bounce from there. So that's to say, so far, the models were being respected. Take a look at the Dow. You should notice something similar as well. We had price bounce from here. And similarly, we reached the opposite side and we had price action actually start to fade from there as well, giving us again the confidence that the Dow so far is being respected in terms of the Scalper volatility box model. Now, we contrast this with the Nasdaq and the Russell futures markets. So if I bring this out of the way here, down below, bottom left, I have the Nasdaq futures chart. You'll notice price action here went outside of our Scalper volatility box clouds. All that to say, early on in the morning, the Nasdaq is telling us that, hey, you can't use the Scalper volatility box on this market today. Instead, you need to adapt to the volatility and switch over to our aggressive volatility box model to try and play both trend and fade trades. So now switching over to the aggressive volatility box in the Nasdaq futures, you should notice by 7 a.m. Pacific now, price action looks a lot better. Still hasn't breached our cyan entry line. So far, this is a much better model in terms of encapsulating price action compared to the Scalper, and that's why we were on the aggressive. Similarly, if you look on the Russell futures here, we had price action again go outside of the clouds right here, even for a wick, and that then took us from our Scalper to the aggressive volatility box models, and that's what we were using as of 7:25 a.m. Pacific. Now, the one thing I'll point out is usually we have the 3 major indices here at least. At some point, their volatility starts to equalize and they start to follow one another. So when we usually have a market leading like we had today, so today we had 2 futures indice markets telling us that, hey, they were currently leading with the aggressive volatility box model. That then gave us the clue that, hey, the S&P and the Dow most likely should catch up as the day progresses. Now, that's to say, if you were a bit more of a cautious or conservative trader, then that would be your preemptive sign to just switch over to the aggressive volatility box and use the highest volatility box model that you're on as sort of your baseline scenario for all 4 futures markets. Now, today playing this aggressively was not a smart idea, at least, and that was a fade first in the S&P 500 futures, and that was a scalped fade, so let's go through that one first. So if I expand my charts here, as the day progressed, we had price action fall inside of our Scalper volatility box. So far, this was being respected, and this is shortly after I sent out that email, we got the breach in itself. Then if I keep going forward here a bit, we had price action fall deeper inside of our clouds, and then we got the edge signal that we were looking for. That's the setup. We want to see a breach of our cyan entry lines. Once we see that, we'd like to see an edge signal confirmation on at least a 1-minute time frame chart. And from that point, the trade's really a go. Our entry is at the cyan line or better, and you'll notice price action here gave us a much better entry, really closer to the clouds, which allowed you to cut your risk in half. If you entered at the clouds, your risk was right around 4 points, plus a bit of a buffer if you gave it one. And that saved you right around a 3.5 point-ish entry from the actual cyan entry line. Now, even though you got a better entry, depending on where you had your target here, the S&P did not give you a full rally based on the cyan entry line to the outer edge of the clouds. And so following the actual setup here, the S&P here was a loser before we had price action actually start to reverse. So we had a bit of a chop, and then price started to go down outside of our clouds, and in these wicks right here, that's where even the buffer was taken out on the S&P 500 futures, and this trade was actually a loser. Now, the one way you could have avoided that was, again, using those same clues that you saw in the morning and just preemptively switching over to the aggressive. However, that also leads you to missing winners at points as well, and if you did get an opportunity to enter at the clouds, just to give you an idea of what that looked like, that was a max gain of 9 points, but we were still looking for closer to 12.5 for the actual setup rules to have been met in terms of the winner based off of the sign entry line as price. So that's where, depending on your trade style, you may have just avoided this trade altogether. But coming over here, if I switch over to the aggressive now, once we had price action go outside of the clouds, we zoom out, you'll notice nowhere else did we have entries for the rest of the day. Now we contrast this with the Russell here. If I come in, the Russell, we were already on the aggressive volatility box to start off with. That's where we had price action in that same 7 to 8 a.m. Pacific hour. We had no trade setups in the Russell. It's only in the 8 to 9 when volatility continued to increase in the Russell where we had price action breach our sign entry line. We then had an edge signal confirmation on that same 1 minute time frame chart, and you had an opportunity to enter at the sign line or better, and you had multiple opportunities in terms of candles. Now from that point, the bare minimum first move that we were looking for was from the sign line to the outer edge of the clouds, which is right around 7 points, and our second target with the break-even stop was closer to 12.3, 12.2 points. Now we ended up having a bit of chop around sideways until we hit that first target, and then once we hit the first target, moved our stop to break even, which never got taken out, and that move then in the Russell took us to T2 as well. So this is where price entry took place. Our first target was right around here, and our second target was this gray target line, which we ended up hitting as the day continued to progress in that 9 to 10 a.m. Pacific hour. So the Russell here was a better trade in terms of using the more conservative model with the aggressive volatility box. And then we contrast that with the S&P 500, where you had both information that you expected the S&P to really start to catch up to its peers in terms of volatility, and you had a deeper entry in the S&P 500 futures compared to the sign entry line. All right, so hope this helps to give you not only an idea of how to walk through each of the volatility box models at 7 a.m. Pacific and how to use those clues to try and position yourself a bit better for the day, but also how that positioning translates through where knowing that you expect more volatility can allow you to at least start to adjust a bit of your trade parameters, whether it's adjusting down the entire volatility box model or waiting for more conservative entries like ones at the clouds. Either way, hope this video helps. Take care, everyone. Good luck trading, and we'll see you in the next update.